Welcome to Bloomberg Markets. I'm Shanali Bassick. Investors on a wild ride this week. We see cracks in the tech-heavy rally that has driven stocks to a record high. Let's get a check on these markets now. The S&P 500 had been fluctuating throughout the day. You are watching it seep into the green. It's about 0.5% higher, though. The Nasdaq 100 also now in the green firmly, about 0.2% higher. The Philadelphia Semiconductor Index still not getting any love, about 0.2% lower still on the day. Two-year yields, however, now down another 2 basis points off that strong GDP data this morning and a day ahead of that PCE data, of course, the Fed's preferred gauge of inflation. We're going to get a closer look at the market here with Abigail Doolittle.
Well, it's been a wild day, as you were just mentioning, Shanali. At the lows, the Nasdaq 100 down 1.7%. This after yesterday having its worst day since 2022. So the big movement that we're seeing here from a micro level, take a look at NVIDIA. Around the time of the open, down just slightly, but at session lows down almost 7%. After falling 7% yesterday, we are seeing a rebound now to some degree, up 0.5%. What makes this so interesting, the stock well below a key support level of 118. So long as it stays below 118, this suggests that investors are really awaiting that quarterly report, but at the end of August. So there's quite a bit of waiting to see whether or not they can beat and boost in such a big way if that AI story is there. Let's take a look at some other movers on the day, a little bit of that bull-bear battle beneath the surface. Tesla up 3%. Interestingly, throughout today's volatility, Tesla, after falling yesterday on a somewhat mixed quarter, but probably okay for the long term, up all day, up about 3%. ServiceNow up 14%, very strong quarter, good outlook, green shoots for Gen AI. Microsoft, though, this is one of the stocks to the downside. This is one reason that stocks aren't flying higher, still a bit of a drag. Broadcom, though, encouragingly joining NVIDIA, trading to the upside. From a macro level, though, something that's been interesting all week is as we've been having lots of volatility, the yen has rallied. The haven yen has rallied. If we take a look at a 4-day chart here, we are going to see that the dollar yen down 2.2%. That tells you that that haven yen, there is a flight to safety, and that the carry trade, that the cheap yen, it's no longer able to use as a carry trade. And this could be a big reason, especially today's action, as to why NVIDIA dipped down when there was less cheap money available. And now that the yen is coming off of its highs and the dollar yen is coming off of its lows, it creates the opportunity for investors to have a little more liquidity. I think the reason, Shanali, one reason at least, that we're having this flight to safety, yes, of course, too far, too fast for big tech, but election 24, my gosh, so many different headlines in terms of what's happening. Let's take a look at the VIX, because the VIX relative to election 2024 has been a great tell all along this year. The curve out in October, November, and next year elevated toward an 18 handle for much of this year, including out of the assassination attempt on Donald Trump, staying low, but then around headlines on President Biden and then Kamala Harris, VP Harris stepping in. Lots of volatility. I think some of this is uncertainty who will be in the White House next year. In other words, who will win in November. Keep an eye on this VIX. Great tell on election volatility.
We're going to talk a lot more about that this hour. Abigail, we thank you so much for your time. And on the economic front, U.S. GDP growth accelerated by more than forecast in the second quarter, but moderating still from last year. It's a positive sign for both the Fed and the Kamala Harris campaign ahead of that November election. We're going to discuss this all with Guggenheim Securities co-chairman Jim Millstein. And Jim, you are very steeped in the market of restructuring as well. Even with these GDP numbers, you have to wonder what the pain looks like under the surface. Where are you seeing this economy really weakening?
Yeah, look, the economy obviously by these numbers remains very strong. Growth is continuing to tick along, as is employment. But the Fed's interest rate policy is definitely having an impact in the corporate sector. Borrowing, think about corporate borrowing. It's usually done on a 5 to 7 year basis, right? You borrow for a 5 to 7 year term. So you had very low interest rates, ahead of the pandemic and actually during the year of the pandemic. And then, since the Fed began fighting inflation with higher interest rates, the entire refinancing market for the corporate sector has changed. So you have, 20% of the S&P 500 today cannot cover its fixed charges. Its cash flows are less than its debt service. As those corporations now seek to refinance their debts in a much higher interest rate environment, we are seeing an uptick in restructuring activity across the board.
It's fascinating because people talk about this a lot when it comes to small and mid-sized firms, but this is true also for the S&P 500. Do you think investors are ignoring the risk, especially when you see how much money is floating right into risky bonds?
No, I don't think investors are ignoring the risk. Some investors are saddled with the risk and are dealing with it. It's obviously with the Magnificent Seven represent 25% of the total market capitalization of the publicly traded securities. I mean, it's a tale of two cities, right? You've got a very robust technology sector, but underneath that, in industrials and business services, the broader economy, there is this impact of interest rate policy is real.
So let's switch gears here, because very quickly the conversation will turn even more strongly to that November election. What is Harris economics? What is the difference between Kamala Harris and Joe Biden, and how that feeds into policy into the markets?
That campaign is just a couple of days old, so I think, we don't know what new initiatives the vice president may propose, but you have to assume it's going to be a continuation of the historic programs that President Biden achieved, on infrastructure, on climate change, it's been the most, he says this, and I think it's fair to say it's been one of the most remarkable presidencies in terms of shifting the direction of the economy in my lifetime.
How much do you think that the steepener in the yield curve is a Trump trade?
I don't know. Obviously the polls continue to show a slight lead for President Trump, or former President Trump, over the Democratic new candidate. But it's 100 days to the election. That's a lifetime in politics. So I don't know whether it's a Trump trade or whether it reflects, some greater concern with the federal budget and the federal debt. Interest expense is now the second largest category of spending for the federal government after Social Security. And when you look at the federal budget, the things that the Congress argues over, the so-called discretionary part of the budget, is a relatively small number. We spend $6 trillion a year. The discretionary budget is $1 trillion of that $6 trillion. Interest, Medicare, Medicaid, and Social Security, these are the so-called mandatory programs. That's what's driving, our deficits. And there's just no apparent appetite on either side of the aisle to deal with the mandatory part of the budget. That's the steepener may reflect the fact that there is no appetite to deal with a federal budget that is really out of balance.
A lot of investors really do believe that both under a Democratic or a Republican administration, you still have that debt problem ahead. You don't have any reining in of spending. What would be different under a future President Trump if he were to win in November?
Well, let's first talk about the reining in of spending, right? So as a result of the pandemic in 2020, the Congress of the United States, in their infinite wisdom, under former President Trump in his last year in office, basically created $4 trillion of new spending to deal with a real health care crisis in the United States. That spending those programs had 2 to 3 year terms. That is now winding down. So we were spending, $7.4 trillion in 2020, and now the federal government is spending about $6.2 trillion. So that pandemic spending has come off, and we're now dealing with a structural deficit where we're collecting, $4 trillion in revenues, mostly from individuals through income taxes and Medicare and Social Security taxes. Constituting 85% of revenues. We collect about $4 trillion, and we spend $6 trillion, with the pandemic spending now abating. And that structural deficit of $2 trillion, I think that's what's behind the steepening of the curve.
Well, what's fascinating, too, is even if you had President Trump or former President Trump win the office again, would he be able to really extend those tax cuts once they expire? There's a lot of skepticism that could happen.
The federal government needs revenue. You've heard a number of Republicans now say revenue's got to be on the table because they're just, unless you really want to take a hatchet to Medicare and Social Security, there's not a lot left in the discretionary budget to play with. Sure, you could eliminate the Department of Education, as you hear the Republicans say from time to time. It's a drop in the bucket. It's not going to really make a big difference. It may have political currency, but in terms of changing the trajectory of the federal government's deficits, it's not a big item.
Jim, stick with us. Of course, a steeper yield curve might look pretty, but it has some dire implications. That is Guggenheim Securities co-chairman Jim Millstein. He's sticking around. Now, we're going to talk next about Jim's pitch for a federal program to finance new home construction. Of course, the mortgage market is a big topic of discussion, especially today. Stick with us. This is Bloomberg. Welcome back to Bloomberg Markets. I want to take a quick check here at two stocks we're keeping an eye on today. That is Mr. Cooper buying the flagship mortgage operations here of a New York Community Bank. You have Mr. Cooper shares now up more than 9%, but New York Community Bank still plunging really more than 6%, almost 7% on the day. Of course, worries about credit quality at the firm, but at the same time, selling off a subsidiary dealing with residential mortgage servicing. Now, this all ties into our next discussion. We're going to go back to Guggenheim Securities co-chairman Jim Millstein, who has pitched a new federal program to provide mezzanine financing for new construction of homes. Now, you laid out this plan to our colleagues in an Odd Lots podcast with Joe Weisenthal saying that it was probably one of their most fascinating episodes ever. How do you plan to really restart this housing economy at a time where many people believe we're in a pretty serious affordability crisis?
I think we are in a serious affordability crisis. We have, depending upon which economist you talk to, somewhere between a 3 and 5 million shortfall of supply of housing units against the demand that's there. So when these markets are out of balance, when any market is out of balance between supply and demand, you get price appreciation. And that's what we've seen since the pandemic. House prices are up 20%. Typically over the long term, over the last 200 years of American history, house prices appreciate on average about 2% per annum. In the last 3 years, we've seen house price appreciation of 20% and rent appreciation as well, because there's such an imbalance between supply and demand. And so, it depends on markets. Austin, because of the move of various people during the pandemic to Austin had a surge of multifamily housing development, and now rents are softening because the market is coming into better balance. But that's not true in many parts of the country, both rural and urban markets, because of this just enormous shortfall in housing availability.
What you're pitching is sort of a capitalist dream in the sense that it is sort of a public-private partnership of sorts. How do you, though, encourage builders to get into the places that matter? We had this amazing story on the Bloomberg terminal yesterday about how the real estate market is broken for everyone except the ultra-rich. Affordable housing, houses for everyone who lives in a suburb outside of a city in particular. How do you encourage people to build in those areas?
Well, you got to break the imbalance between supply and demand, because if you have excess supply, it'll affect the housing costs in all segments, both affordable, middle, and high end. As middle-income people move into higher-income houses, as their income increases, that creates availability.
Hopefully.
It creates availability. So my idea, and I'm not, unique in this, there are a number of people who think this is a needed federal program, is to provide concessionary mezzanine financing. Typically, construction is done 60-40, 60% senior debt, 40% equity. The idea here is to have the government step in and provide a mezzanine layer of 20%, allowing the equity to be slightly more levered.
Through Fannie Freddie.
Well, it could be done if Congress stepped into the breach. They could create a new financing bank, or they could authorize the Treasury Department's federal financing bank to do this kind of lending. It could be done by Fannie today. It could be reauthorized by Congress to have them do it across the board.
Well, this brings up another question. A large mortgage, bond hedge fund sent out a letter to investors pretty recently saying that they believe the Fannie Freddie structures might change under a future Trump administration. Yeah. How do you think that works?
Well, look, we began the financial crisis with Fannie and Freddie in terms of the government's intervention on September 8th, 2008. The government created a conservatorship over Fannie and Freddie, ultimately put $192 billion of taxpayer money into them to stabilize their financings. The federal government has received more than $300 billion back on that investment. So the taxpayers have been repaid handsomely, but they remain in a federal conservatorship and have done for the last 16 years. Former President Trump, during his first term, tried to end the conservatorships. There was a real effort made, but he lost the election and they ran out of time. So he has made it clear that if he were to be reelected, he would try to end the conservatorships again.
What else would change?
Well, the biggest change would be, instead of being controlled by the Treasury Department and the Federal Housing Finance Agency, who control, in effect, their equity and their board of directors.
I mean, in the economy under a Trump administration.
Well, look, it's hard to know. The Republican platform has been published and is out there. The former president, in his speeches, talks about a 10% across-the-board tariff on all imports in the United States. We import about $4 trillion worth of goods and services a year. That would be a $400 billion increase in the price of goods and services coming into the United States.
Inflation.
It's a price increase. Tariffs are ultimately paid by the consumer now. So that's just a price increase. It would be, I'm not an economist, but economists, say that would have an inflationary impact. The other big initiative he's talking about is, the largest deportation program in American history of, undocumented residents in the country. He talks about 15 to 20 million people to be deported. That would be hugely disruptive of labor markets, and that could be inflationary, right? If you have fewer workers to fill the factories or the agricultural fields or food processing plants or restaurants, you're going to have real pressure on wages, and that could build in some significant inflation as well.
Jim, we thank you so very much for your time. We have to have you back closer to November as well.
Okay.
That is Guggenheim Securities co-chairman Jim Millstein. Now, coming up, we're going to continue the real estate conversation, turning now to luxury with Sean Hehir of Trinity Investments. Stick with us for that conversation next. This is Bloomberg.
An office has been decimated, and it continues to suffer. And so you take that with a rate environment which is higher for longer than most people thought it was going to be, and it's just not. We have not yet lent to regular way office buildings in the United States, right? And one of the questions I get asked a lot is, do you think we've hit bottom there? I think it's hard to say that we've hit bottom there, right? And so it's hard to have conviction to go in and do that.
This is Bloomberg Markets, and I'm Sonali Basak, and that was BGO's Sonny Kalsi. And right now, Bloomberg's Abigail Doolittle is with Trinity Investments managing partner Sean Hehir to discuss the stress surrounding commercial real estate, especially one area that might be standing out amid all this concern. Abigail.
Absolutely, Sonali. Thank you so much. And Sean, it's great to have you back with us this year. It's been about a year since we last spoke, and you, of course, know Sonny, larger than life. His assessment there, and he was very honest with us yesterday, the good and the bad. So starting off with the good, and we'll return to it in a moment. But when we spoke last year, your assets under management, about $5 billion in luxury hotels around the U.S., Hawaii. I know that you've now added a property in Europe, now $6 billion. So in this environment, you are actually increasing assets. But this difficulty that we're hearing about in office, are there ripple effects? And in terms of this slow moving crash through real estate so many people are tracking, how do you see it? Is it almost over? What inning are we in?
Well, thank you for having me, Abigail, and I feel honored to follow Sonny Kelsey, who's a great friend and a terrific guy. But, you know, I'm a hospitality investor. I've had experience in other asset classes, but I'd say hospitality, we've had the benefit of being able to release every night. So we've been able to adjust prices dynamically, both on the room rate side and food and beverage. In addition to that, we typically trade at wider cap rates than other real estate asset classes. So if we're typically buying at a 7% cap rate and interest rates are now 8%, there's slight negative leverage, but with a value add investment, we're moving our way towards positive leverage. The other asset classes are tougher, where you're buying at a 4 cap and used to be, you know, needing a 3% fixed rate loan to make the math work. So we feel privileged to be with the type of assets we're in our asset class.
And so you do think it's tough out there for some of the other asset classes, such as office and other areas of commercial real estate. Could take a little while to work through this?
It is tough. And the one thing I've learned, you know, over the last 4 years, having lived through COVID, is the power of relationships. So we've been able to acquire assets through our relationships with the hotel brands, Hilton, Marriott, Hyatt. We've been able to continue to finance our acquisitions through our relationships with the lenders.
Well, talk to us about that, because when you were here last year, you had just refinanced the Westin Maui, which was no small feat. What is that environment like right now? Are you able to get financing easily? And if other areas aren't, what is it about your company and hospitality?
Yes, thank you, Abigail. So we've closed on about $2 billion worth of financings or refinancings over the last 11, 12 months. Again, it's back to relationships. And again, it's having been disciplined about the types of assets we own in the markets where we are. So we're disciplined about Florida, Texas, Arizona, California, Hawaii. They're all destination type markets. These are all assets that are sort of 400 rooms and larger, more destination type properties, and disciplined with the brands who have been strong partners.
And what are the travel trends like? It's interesting. American Express reported recently sort of a mixed quarter, but they were talking about spending being light in soft areas of discretionary. Are you seeing that enter the overall travel picture, or is it pretty strong for your properties?
Well, I'm watching credit card debt, as we all are, but you know, I read a statistic today that Jan Freitag put out that luxury had a 9% demand growth in the month of June. The economy end of the hotel segment, I think, was, you know, about a 2% drop. So we're in the right sector. You know, I landed back in New York the weekend before July 4th, and that Friday was one of the busiest travel days in the history of the country. So people are still traveling, and our properties are benefiting from that. That's
wonderful. I'm so happy for you for all of your successes, and we'll look forward to speaking with you again. Sean Hehir, principal of Trinity Investments, has just joined us. Shanali, and back to you.
Absolutely, Abigail. We thank you so very much for your time. That is, of course, Sean Hehir and Bloomberg's Abigail Doolittle. Now, coming up, Carlyle's Akhil Bansal joins us for a large conversation about a big deal just days ago. Stick with us. This is Bloomberg. Welcome to Bloomberg Markets. I'm Shanali Bassick. Let's get a check on these markets. We are hitting session highs in U.S. stocks. What a wild session it has been. You're looking at the S&P 500 now up almost 1%. The NASDAQ 100 now at about 0.8% higher nearly. And you're looking at a 2-year yield here just around 4.40, I believe. And you're looking at a 10-year yield at 4.24. So some softening after that economic data that we have seen out there, but really the bond market moves really starting to moderate on the day ahead of that PCE data tomorrow. Midday movers on the equity side. Ford is having its worst drop since at least 2009 on a closing basis. On an intraday basis, it's the worst day so far since 2020. It comes after it announced a second quarter profit that fell short of estimates, and it lowered its 2024 outlook for gas and hybrid vehicles. Ford attributed the results to quality problems with its vehicles that led to a surge in warranty costs. Also keeping an eye again on those New York Community Bank shares, also down after credit losses were worse than expected. There are still concerns about its outsized exposure to commercial real estate in New York as the company's CEO works to transform it into a, quote, relationship focused regional bank. We're going to stick with the world of credit here because high-grade issuance for July is nearing $100 billion. Blue chip companies like Occidental and United Health helping to drive sales to the fastest rate for any July since 2017, as borrowing costs trending downward since April. Pretty remarkable when you think about elevated volatility this week, yet you have had both bond markets and equity capital markets wide open. Bloomberg's Olivia Raimondi reported on the reason behind the sales surge in the bond market. She joins us now. What is the risk appetite out there right now? Because it seems pretty insatiable. What have we seen this week?
Hey, Shonali, thanks for having me on. Yes, risk appetite has been insatiable in the corporate bond market, and we're seeing that with companies coming and offering very large bond deals. We had Occidental Petroleum coming, selling $5 billion to help refinance a bridge loan it took out last year for an acquisition. What was really interesting, though, was United Health's $8 billion deal for a refinancing. You don't typically see people come, or companies come, excuse me, to refinance $8 billion in one slug. That was the fourth largest deal of the year, and it was received very well by investors, very strong demand. And so it shows that even though we're in the summer period where corporate bond sale issuance typically tapers off, we're not seeing that at all this year. If anything, it's getting stronger.
Speaking of demand in credit markets, you're seeing high yield bonds getting a bid, and there was this fascinating column on the terminal over the weekend. The idea that the real Trump trade is a high yield bond. Is it true?
That's what my sources are saying. People love junk bonds for many reasons, and a big reason why high yield would be advantageous in a red sweep. So not only Trump, but also if they were to take the House and Congress on the Republican side as well. And that's because, well, one of Donald Trump's main platforms is to lower a corporate tax rate, right, which would really help bolster the fundamentals of some of the weaker corporate issuers in the U.S. junk bond market. It would help them shore up their financials and their fundamentals. And also a lot of his tariff and protectionist policy attitudes that would help a lot of high yield borrowers who pretty much mostly have domestic exposure.
Olivia, always with the next hot trade. That is Bloomberg's Olivia Raimondi. We thank you so much. Now, just last week, Carlyle continued its push into private asset-backed investing. We've been talking about it. It's been a very hot market for private lenders right now. And Discover sold its more than $10 billion private student loan portfolio to investment vehicles and accounts managed by KKR and Carlyle. We're going to discuss this now with Carlyle's head of credit strategy solutions, Akhil Bansal. And large deal we were looking at here, $10 billion deal. How many deals like this are out there in the market? Can you imagine another one like this getting done even in the next 6 to 12 months?
Yes, I mean, I think it's more representative of this shift of lending away from traditional deposit-taking banks and going into the private markets. And if you look at how many assets are residing on those bank balance sheets, it's trillions of dollars. And so even though this is a very large transaction, I think it's actually a tip of the iceberg of the amount of high-quality lending that resides on those balance sheets that's going to be looking home on the private markets. And it may not be only portfolios that exist on the balance sheets today, but it's also about the future lending that would have gone on those bank balance sheets. That's another area we're very active in.
Pretty fascinating, because even beyond the banks, this was a large credit card company as well. When you saw this portfolio, bring us a little behind the deal. Why was this attractive to you?
When you think about private student lending, it's just a very attractive credit asset class. A lot of these loans are co-signed by parents, so you have not only the student's credit to look to, but you also have a parent or a guardian. And the fact that the person you're lending to is getting an education, that makes that borrower more creditworthy. People with education have higher earnings, they're more recession resistant. And so those are very attractive credit attributes, and that attracted us to this portfolio, and I'd say private student lending more broadly.
So you were talking about this multi-trillion-dollar opportunity off the heels of bank balance sheets. These are student loans we're talking about. What other types of assets are interesting to you? Yeah,
I think we're really focused on really high quality type of lending. And we have some really thematic views at Carlyle that we're expressing that through. For example, we think that when we think about who's going to be a recession resistant cohort of population of borrowers to lend to, we think that the homeowner fits that bill. The homeowner has been very much insulated in this inflationary environment because 40% of inflation is shelter and housing cost. And if you own your home and have that low coupon 30-year mortgage, you've been really insulated from that. And in fact, you've benefited from the wage growth you've seen in this inflationary environment. So things like residential solar, which aligns with the deal we did earlier around SunGauge that we talked about, things around home improvement. And then we're even in areas where we're looking at second lien mortgages, where people don't want to refinance their first lien mortgage, but are still taking take money out of all this equity that's been built up in their homes.
How do you scour the market for decent credit quality? One thing I've been taking a look at here is, for example, in the larger banks, say Bank of America. If you are a residential homeowner there getting a loan, or a auto loan borrower here, you're looking at credit scores of 770 or above, sometimes above 800 in FICO. How do you think about the quality of the borrowers as you buy these books like you did with Discover?
Yeah, we're always looking for Carlyle where we have an information advantage when we're looking into the pools that we're buying. It's not just about looking at a FICO score. It's about how can we use our platform and the breadth of it to actually pull insights out of it that make us a better buyer of those pools. And Discover is a good example. We have a portfolio company called Monogram that was very important in that transaction. That company has a 30-year proprietary data set on private student lending, as well as many other capabilities on the oversight and compliance around student lending. That gave us a real edge in that asset class, and I think that's how we try to approach the market when we look at these pools.
That's pretty fascinating. And how do you feel when you look outside of the giants like Discover? If you're talking about a regional banking kind of opportunity here, right? Just this morning, for example, you saw New York Community Bank sell a large asset to a non-bank. What types of assets would the banks have to deliver? Is it mostly mortgages these days? And is the credit quality as firm there as it is elsewhere?
We are seeing regional banks increasingly look to sell portfolios of loans. And what we're seeing them, frankly, focus in is on the higher quality loans, because that's where they can get the best price, as opposed to selling something that's more challenging and where they're going to take a write-down and a loss and create a hole in their equity balance sheet. So, and it's not relegated to only mortgages. There is consumer lending, small business lending, equipment and finance lending. That's all high quality that we're seeing come out of those types of regional banking institutions. You
mentioned recession resistant. You're looking at things that can kind of make it through the next cycle. More and more people are worried about a recession. Yes, you saw great economic data this morning, but you're seeing a slowing of the economy more broadly. How do you feel about the risks out there right now?
Yeah, listen, we have to be cognizant of the risks, and one of the big risks of our strategy is the risk of credit losses. I think we're seeing a tale of two worlds, particularly in the consumer area, where you're seeing the more higher quality, higher income, more assets own their home. That borrower is doing quite well in this environment. Where we're seeing the stress is actually down with the less credit-worthy type of borrowers.
Akhil, we thank you so much for your time. Of course, that is Carlyle's Head of Credit Strategy Solutions, Akhil Bansal, on the heels of a massive deal. Now, coming up, we're going to talk about Royal Caribbean restarting its dividend for the first time since the pandemic. We're going to discuss the strong demand we're seeing in the travel sector and the risks out there with, of course, the CEO of Royal Caribbean, Jason Liberty. Stick with us. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for the stock of the hour. Royal Caribbean shares are up around 20% this year. They're under pressure today, and it comes despite being the first cruise operator to reinstate dividends since the pandemic. The company also raised its profit outlook for the third time this year as it sees record demand. Analysts, though, are concerned that the growth in the amount of revenue made per cruise will slow. And we have the perfect person, of course, to talk about it. That is the CEO himself, Jason Liberty. And if you take a look at how your stock is reacting when you put up a dividend and raise your forecast, what do you say to investors today?
Yeah, well, I don't think we can really understand the reaction to the share price. And so I always say let's focus on what we can focus on, which is delivering the best vacation experiences in the world. I think clearly we've been doing that, and that is resulting in a flight to quality, which is producing record earnings in the second quarter. We significantly outpaced our expectations. We raised the back half of the year even further, raising our guidance for the year. Our year-over-year earnings per share growth is 68%. As you mentioned, we reinstated the dividend, and we've talked about very strong demand patterns that continue here as we're at full load factor on our business, and so it's really being all driven by price. And the other point I'll just make, Shanali, is that one of the big drivers on the price side is that we still trade at a significant discount to land-based vacation. The cruise industry is a small sliver of the $1.9 trillion travel industry. And we wake up every day and try to figure out how do we continue to take more share and close that gap to land-based vacation.
Do you think investor expectations are just for consistent, blow it out of the park, rapid growth here? Because you get out of the pandemic, people are very excited to get back out there and travel again, and you're looking at a market that is trying to sniff out any sign of a weakening consumer. How do you gauge that fear?
Yeah, well, I think we've seen this now for several quarters. I think sniff out is a really good phrase to use. Is they're trying to find some type of crack in the story around cruise, and of course, we're for this year, our yields are 25% higher than they were in 2019, and we're further ahead on the curve than our cruise peers in terms of recovery. And so a lot of it is just the comparables, that there's a reality of a level of normalization that will happen here in our business. And so I think for us, because they keep trying to sniff out that and they're not seeing that in our business, I think it's a little bit of a conundrum for them to try to figure out why are we not seeing this in cruise. And I just go and I point back to the reality of we used to trade at a 10 or 15% discount to land-based vacation. The industry probably trades at somewhere between 20 to 25% discount to land-based vacation. So there's still that value gap for us to be able to go out there and close.
Let's talk about pricing as well. How much wiggle room do you have?
Yeah, well, we have through the course of this year. I mean, when we entered this year, we expected our yields to be up about 6.5%. Our current guide has that over 10.5% for the year, and that's all driven by price. And some of that has been close-in demand, but also it's just the balance of as we're taking in new bookings, which we get to see each and every day, the willingness for our guests to pay more for those experiences are very welcoming to them. They're willing to pay it, and they're also willing to book much further ahead. So we see that extension of the booking window. So we have our visibility is building more and more for 25 and 26, and also they really want to capture the experiences that they're going to have on the ship. So we see a lot of pre-cruise sale bookings, and we know that if you book with us before you get on the ship, you tend to spend that same dollar again when you're on the ship.
To that end, how does 2025, 2026 look, and how much price pressure could there be on the upside?
Well, from all that we can see, right, we have, we're taking 25, 30, 35,000 bookings a day, depending on the day. We see the cash register ring every second of every day all around the world. And what we see is a consumer that is continuing willing to pay more money for cruises in the future and to really capture the experience that they want to have. So we feel really good, and our brands are just so well positioned across all these different segments. They're the leaders in their segments. There's a flight to quality. And we're focused on this concept of making sure that we're set up to deliver a lifetime of vacations. And that seems to really resonate well with our guests. And now that we have combined our loyalty programs across our brands, that's really giving them a great reason to make sure that experience is going to happen on one of our cruise lines.
I'm really curious about how you think about this macro story as well, Jason. You look at inflation, there are signs that it's starting to cool. You look at the expectation for interest rates coming down later this year. What does this all mean to you at the end of the day? Is it helping you when it comes to the cost of goods? Is it inspiring you to maybe take on more debt if rates do come down?
Yeah, well, I think just to start off on the balance sheet side, we've now gotten ourselves back into more or less our pre-COVID balance sheet. We got a little bit more work to do to make sure it's secured. But I think for us, lower interest rates obviously can free up some of the credit, not just for us, but also for our guests. But I think, Shanali, one of the things that we look a lot into when we think about macro trends is we really try to isolate it down to our customers, right? Our average customer for our Royal brand, has household income somewhere between 125 to 150. They tend to be homeowners. They have pretty strong balance sheets. They have great jobs. And then, of course, as you go up the line to our ultra luxury with Silver Sea, you've got household income that's $350,000, $400,000. A lot of that is passive income. And so when you look at that customer who we're addressing, they're actually very healthy. And their willingness to spend and their willingness to plan into the future seems to be very robust.
Jason, we have to leave it there. That's Royal Caribbean CEO Jason Liberty. Now, coming up, OneStream surged in its public debut yesterday, but the company could be an outlier because tech IPOs are getting harder and harder to appeal to investors. But that doesn't stop the fact that we have the year's largest, listing today. More on the IPO market up next. We'll talk more about it. This is Bloomberg. This is Bloomberg Markets, and I'm Shanali Basak, and pour one out for the deal makers. We're looking at investment banks today. Evercore stock sitting at a record, if you could believe it. And you have Lazard jumping to the biggest degree since March of 2020 with a more than 11% gain, now more than 10%, almost 11%. Moelis also rising. Lazard hitting a record first half revenue under new CEO Peter Orszag. Remember, Evercore also announcing record revenue yesterday. That's all amid what they hope is a continued investment banking rebound. And part of that is, of course, the rebound in capital markets. Remember that the sharpest tech sell-off in nearly 2 years is threatening to make IPOs an even tougher sell for investors, but there are some significant outliers. Shares of fintech platform OneStream just surged in trading yesterday. And today we have temperature-controlled storage and logistics giant Lineage going public in the biggest IPO of the year. Bloomberg's Amy Orr reported on all of this. She joins us now. And you think about the fact that we had a major sell-off yesterday and Lineage still upsized. How much demand is there for IPOs in this market?
Well, it's hard to actually say because Lineage is not really tech. So like the sell-off was really tech-driven, right? Because it has run up so much. And then if there's anything, I would rather kind of look at OneStream yesterday was because OneStream actually did perform. But then the kind of demand for it was strong. But then what we've heard when it was about to price was that it can price $2 more than what it went for. It went for $20, which is above the range, but it could also be upsized as well.
Stick with us here because, of course, we also have a Lineage opening here at $82 a share. The IPO was priced at $78, so that's a second day in a row. You are seeing a significant pop in that IPO market. And, of course, we know, as you've been saying, the interesting thing about Lineage, not a tech company. Do people want things that offer more diversity here than tech in this market?
And also it's very interesting that the three biggest IPOs of the year so far are not really tech. So Amer Sports and also Viking as well. So this stock in particular gives a good diversification. And also it's a very interesting stock in itself, right? Because the only other listed peer is just Americold. So this is in a very different kind of unique environment segment of the market that people are trying to diversify into. And also the size of it is so huge as well. And then, so yeah, it might actually go into a lot of the REITs index. So that's probably why investors are thinking, maybe I'll just, put money to work in things like this.
Fascinating, too. You're seeing that 5% pop at the open of Lineage. You know, you think about the IPO market as part of the frustration here that the pipeline is just not that big for more deals. This is maybe one of the largest you're going to get this year.
That's probably true. And also there are quite a number of companies that probably should have gone or still eyeing the July or September kind of time frame, might not even go. So the timeline is, the pipeline is very fluid at the moment.
And with M&A also still under pressure on the large scale, of course, the IPO market gets even more attractive. That is Bloomberg's Amy Orr. I'm Shanali Basak. That does it for Bloomberg Markets. What a wild day. Coming up next, though, FTC Chair Lina Khan joins Balance of Power. Certainly the woman of the hour. This is Bloomberg.